Jason Bond from the Boole Microcap Fund. The greatest investor of all time, Warren Buffett, says that the best book on investing ever written is The Intelligent Investor by Benjamin Graham. And Buffett says that you only need 2 chapters from this book, chapters 8 and chapters 20. In those 2 chapters, you will find 3 key ideas. First, that when you buy a stock, you're becoming a part owner of a business. Second, market prices are there to serve you and not to instruct you. And third, you want to pay a low enough price so that you have a margin of safety. As to the first idea, stock represents a partial ownership stake in a business. And so anytime you buy stock, you're becoming a part owner of the underlying business. Many people will look at stock prices, but stock prices can bounce all over the place, especially over shorter periods of time. Over a long period of time, though, if you've paid a reasonable or a low price for your stake in the business, your results in holding that ownership stake will mirror the results of the underlying business. So you always want to think like a business person and look at the business that you're becoming a part owner of. The second idea, that market prices are there to serve you and not to instruct you, is illustrated by Mr. Graham with a wonderful analogy. He says, think as if you have a business partner named Mr. Market, and every day Mr. Market will come and name a price for the business, and you can either buy Mr. Market's stake in the business at that price, or you can sell your stake at that price to Mr. Market. The thing is that Mr. Market is manic depressive, and he experiences emotional mood swings. Some days Mr. Market will come to you and, being very optimistic, will name a very high price for the business. In that case, you would be wise to sell your stake at that high price to Mr. Market. Other days, Mr. Market is rather despondent, and he will name a very low price for the business. In that case, you would be wise to buy the stake from Mr. Market in order to increase your own ownership of the business at that low price. At all other times, for prices in between the very high price and the very low price, it's best just to ignore Mr. Market and stay focused on the results of the business that you have a partial ownership stake of. Regarding the third idea, margin of safety, you want to pay a price that is roughly 50% or less of what the business is worth. What the business is worth, the intrinsic value of the business, can be estimated in 2 ways, either by the book value, in other words, the net asset value of the business, which is assets minus liabilities, or by the future cash flows of the business discounted back to the present. But if you estimate that the stock is worth $100 a share, you want to pay $50 a share or less. And that difference between the 100 that you think the stock is worth and the 50 that you pay represents your margin of safety. The purpose of a margin of safety, according to Ben Graham, is that it protects you in those cases where you've made a miscalculation or where you have worse than average luck. And both of those things will happen. Good value investors are right about 6 out of 10 times and are wrong about 4 out of 10 times. And so in every case in your portfolio, if you've paid that low price, in those cases where you've made a miscalculation or you have worse than average luck, your losses are going to tend to be contained. In those other cases, when you're right, you will roughly double your money. And so your overall portfolio will tend to do quite well over time. Usually it will produce results better than the market over the long term. Whether you're just starting out as an investor or you've been investing for a long time, it's always a good idea to read chapters 8 and 20 of Ben Graham's The Intelligent Investor. If you liked this video, please hit like and/or subscribe. Thank you.